Hi, everybody, and welcome to our presentation on 5 financial drivers to reduce costs and make more money in your business. So my name is Kary Shumway. I'm a CPA, CFO, numbers guy, partner and CFO for Wormtown Brewery, and I've spent about 15 years as CFO for a beer distributor in the Northeast. And I founded Craft Brewery Financial Training as an online resource for craft breweries who are looking to learn a little bit more about finance and financial planning and how to improve profits and cash flows. So I'd love to hear from you if you have a question, if you just want to connect. The best way to get me is Kary@beerbusinessfinance.com. So I want to say a big thank you to my friend Andrew Copeland for having me and Craft Beer Professionals. And I'm excited to be here with you at the Spring Virtual Conference. So this is what we're going to talk about today. I'm going to go over the financial drivers for your business. And you know what, I work with a number of breweries and other beer businesses. And one of the biggest challenges, or what folks are most interested in learning about, is how to identify areas where I can make financial improvements in my business. Now that could be cutting costs. Like many people feel like, oh, there's low-hanging fruit. How do I find it? So we'll kind of cover some of those areas and talk about the main drivers of what is producing the outcomes in your business and how you can kind of, pull certain levers in order to make improvements. We'll talk about those tactics to reduce costs, just a couple of simple things you can do that can make a big difference. So I'll go over really a process that you can follow and some simple things like purchase orders and the basics of cost review, kind of how I look at it, how I would run through the income statement to look for areas of opportunity. And then financial planning, it's really, these are in reverse order. I mean, everything, whenever I work with clients, the first step is asking the question, do you have a financial plan? Do you have a budget? And most of the time the answer is either no, or we started one, or we just never quite finished it, or we didn't, we've had them before, they haven't worked. So it's the old saying, and if you don't have a plan, if you don't know where you're going, you can take any road and you'll get there. And you want to have a plan to get a roadmap to get to the place where you want to ultimately to achieve the financial outcomes you're looking for. So we'll talk about those best practices, some starting points, some models that you can use to achieve those outcomes. I do on this topic. I do have a free course that's on brewery financial planning. So you can scan this QR code or just go to craftbreweryfinancialtraining.com and check that out. But this is going to give you more of an overview on the financial planning process. Of course, it's maybe 45 minutes, so you can kind of run through the videos, get the downloads and whatnot. So if you want to check that out, you can just scan this code here. All right, so let's dive into it. These are the financial drivers I want to cover today. These are the main drivers of cash flow and really how you can achieve those improved outcomes in your businesses by focusing on these 5 areas. So accounts receivable and inventory, accounts payable, capital expenses, and your loan or debt payments. So I'm going to go through each one of these, kind of describe what it is, and provide a scorecard for each one, so you can really measure, how are we doing relative to each of these drivers and what does improvement look like, and then give you some action items that you can take to try to improve each of these areas. So the goal is really identify the drivers of your business, measure them independently, and have a goal for each one of them, and you focus on them, and you will in fact make improvements in your financial outcomes. So the first driver is accounts receivable. Basically, this is most relevant for breweries that are either self-distributing or selling through a wholesaler. So these are sales that you've made that you haven't collected yet. And what we want to use to measure this is something called days sales outstanding. So we really want to know how many uncollected sales we have out there, and how does that compare to the credit terms that we've extended. So often we'll have credit terms of, say, 30 days. So we want to kind of do the measurement and say, are we collecting within our credit terms in general? Are we, are customers paying too slow? How does it look? So the calculation, days sales outstanding, looks like this. We're really taking our accounts receivable balance, those uncollected sales, and dividing it by the average daily sales that we would have seen, say, in the preceding month. So I tend to run this around the first of the month for the month prior. So we're recording this here in early April. So I'd like to look at what were the sales for March, for example, and what's my accounts receivable balance at the end of March. So the math on this looks like this. The accounts receivable balance, let's just say at the end of March, is $250,000. And then I want to say, what were my average daily sales for the month of March? So I take the month, divide it by number of days in the month, and in this calculation, we're seeing about $10,000 a day. So in order to get the calculation, I divide average daily sales into the AR balance, and I get about 25 days sales outstanding. So really what that means is that there's 25 days that I've sold product, either self-distribution to retail or through my wholesaler, that I haven't yet collected. So again, that number is not going to mean much in and of itself, but if we compare it to our average credit terms, and let's say it's 30 days, we extend credit of 30 days, we're collecting in 25. Generally speaking, it looks like we're managing this particular driver appropriately. The other way to manage accounts receivable is to just run a simple AR aging report. It's an aging summary. So really what this is, if you're using QuickBooks or some other system, accounts receivable aging report, it's going to list all of your customers down the left. It's going to list the age of the invoices across the top. And it's going to give you some indication as to whether or not things are being collected in a timely fashion. So again, if we are extending credit terms of 30 days, we'd expect most or all of our outstanding receivables to be in that 0 to 30 column. That indicates 0 to 30 days. That's how old the invoice is. Anything beyond that is a potential collection problem or an opportunity to go out there and collect and bring in some cash flow. So if you see anything in the 31 to 60 day column or even beyond, that's really an indicator. All right, it's time to resend an invoice, send an email, pick up the phone and make a call, send the sales rep in if we have a sales rep from the brewery calling on a retail account, for example. So these are just a couple of tools, simple tools you can use to improve this driver of financial outcomes, accounts receivable. So action items to think about: you calculate your current days sales outstanding, see what that looks like. Set a goal to try to improve it, provided, if it's not in range with where you want to be. And like most things on your finances and even in your business, it's important to have regular routines and process in place so you're keeping an eye on this. So regular routine around accounts receivable aging might look like once a week, we run that accounts receivable aging report. We identify anything that is overdue or getting there. And then we kick in our credit process, which is, again, maybe it's an email, we resend an invoice, we make a phone call. So there has to be some follow-up. One of the things that I've noticed in my experience is there are certain people that love to collect money, and there's a lot of people that don't. So if you've got an issue with accounts receivable and collections, sometimes it can be a great benefit to find that person that really loves collecting money, because it can be, you don't want it to be confrontational, but it can be a little bit challenging for some people. So just to kind of be aware of that. The next driver that I want to talk about is inventory. On your balance sheet, inventory is probably the most, let's say, misunderstood asset. So on the income statement, we have the cost of goods sold, and on the balance sheet, we have inventory. And these are related items. So we talk about inventory valuation, proper inventory counts, safeguarding of our inventory. It's a huge asset. It's a huge expense when it makes its way to cost of goods. So it really requires a lot of attention. And if you focus on this, it's really a great way to improve financial outcomes. And one way to focus on it is to do what we call a days on hand calculation. So basically what we're trying to do is measure or really answer the question, do we have the right amount of inventory? Because very often it's like you don't want to have too much because you're hurting your cash flow and your financial outcomes. You don't want to have too little because then you don't have enough to meet market demand. So this days on hand calculation can help you answer that question. Do we have the right amount of inventory? So the calculation works like this. We're really just trying to figure out how much inventory do we have on hand and how does that relate to our expected future sales. So with accounts receivable, we're kind of looking backwards. We're looking at March, what did we sell and what do we have for outstanding receivables? With inventory, we're really looking forward. So on this one, we want to look at it generally from a measurement date of, say, April 1st. Then we forecast out the month of April in terms of sales, and then we do some math to see how our inventory is looking. So you can express this calculation in dollars or cases or units or whatever makes the most sense for you. For the simplicity, I'm just expressing this in cases, and we're talking about finished goods. So the days on hand calculation works like this. We'll start with our inventory on hand, let's say as of April 1st. And for easy numbers, say we have 10,000 cases. And then we're going to look at what our forecasted sales are for the balance of the month. So if we look out over April, what do we think we're going to sell per day? The days are going to fluctuate, but we're really just looking at an average and say we're expecting 500 cases a day. So if we say I've got 10,000 cases now, I'm going to sell 500 a day. Essentially, the way that math works is that's 20 days worth of sales inventory on hand. So my days on hand would be 20 days. Just like with our accounts receivable, if we measure 25 days outstanding receivables, it doesn't mean much unless we compare it to our credit terms. So if we have 30-day credit terms, we're collecting in 25 days. We're collecting quicker than our credit terms. Generally, we're like, okay, I think we're doing all right on that driver. On this one, we want to compare it to what is the turnaround time to replenish inventory? How long does it take to obviously brew and package and get everything ready to go? This is a little bit of a tight, but for simple math, say it's 10 days. So we really want to keep about 10 days on hand. This is showing us we currently have 20 days on hand. So in this example, we might be running a little bit heavy days on hand for inventory. So some action items that you can try out. And again, I did finished goods, but you can certainly look at raw materials and packaging materials and things of that nature in terms of, calculating days on hand, because it's not specific to finished goods. It could be any type of inventory. So first, do the calculation, keep it simple, start with finished goods. Again, setting a goal, where are we at? Where do we feel like we need to be? And then provide regular updates. You can use these scorecards. I also point out, walk the brewery in the warehouse. Most people do it, but if we get stuck in the office, sometimes we forget. And you go out there and you can see some things that might be unusual, like what is that inventory stuck in the corner? How long have we had these packaging materials? These are out of date, so it can be a way to kind of clean up your inventory too, just by doing that eyeball test. The third financial driver is accounts payable, and basically these are unpaid expenses. So we get invoices in. We put them in the system, got to pay this thing at some point. When we eventually pay them, accounts payable is depleted and reduced, but until such time it's sitting there as an unpaid expense. So really what we're trying to get at here is how long are we taking to pay our bills on average? And the goal is we really don't want to pay them too quickly because our vendors and suppliers are giving us credit terms, but we also don't want to pay them too late because then our vendors and suppliers get irritated with us. So we want to maintain a good business relationship, but we don't want to be paying too soon. So one measurement you can look at is days payable outstanding. And what we're looking at here, again, we're going to measure this at the end of the month for the month that just concluded. So I might want to run my accounts payable balance at the end of March. In this example, I've got about 200,000 unpaid bills. Then I want to compare that to the average daily purchases that I made throughout the course of that month. So we can go at this different ways, but for simplicity, let's take the total purchases that we made, and we look at our cost of goods sold section for that, divide it by the number of days in the month, and we get average daily purchases of 10,000. So if I divide those average daily purchases into the ending accounts payable balance, I get about 20 days payable outstanding. So that basically means that's the average age of the invoice that's unpaid right now. Now, in this example, I would compare this to our average credit terms that our suppliers are giving us. And let's just say they give us 30 days. And this is saying, well, you're paying your bills on average within 20 days. They give you 30 days. So it looks like you're paying a little bit early. So all that means is we're pushing cash out the door before we really need to. So again, just a measurement that we can use to make a quick assessment. The other report that's useful to look at is the accounts payable aging summary. This is really a listing of the vendors, that we owe money to and the dates of the invoices that we have in our system that are unpaid. So if our average credit terms are 30 days, we'd expect to see most of our bills falling in that 1 to 30 day bucket, that first column there. If anything's over that, we may want to look at it. Things happen. Did we miss a bill? Did we just never, get the proper documentation to pay it? Are we disputing it? What's going on there? Are we holding it on purpose? So really the name of the game here is, do we recognize and understand any of the outstanding bills that are not within our current credit terms, and is there a reason behind it? So this really just holds all the details. It's a good way to kind of keep your numbers clean as well, to review this on a regular basis. So action items with accounts payable. Start with that calculation, days payable outstanding. Compare that to your credit terms. See if you're paying too early. And if you are, try to identify areas where you can hold on to that cash flow longer. A regular review of the AP aging report, I think, is a good idea because, again, things do get missed. Invoices can become outstanding. And not only do we want to be a good business partner, but we don't want to be surprised by, oh man, we missed that bill for $5,000 and now it's 90 days overdue and we got to pay it right now and we're tight on cash. So it's really just a way to have good financial hygiene, if you will, keep the numbers clean. I'm going to go over this a bit later in the presentation, but another action item for accounts payable is to look at your invoice approval and payment process to include purchase orders, so that we're properly documenting the expenses that we're paying out. So we can kind of go back and say, all right, did we had the invoice matched to the packing slip. The packing slip matched to our purchase order. So what we thought we ordered is actually what we received, and what we received is actually what we're getting billed for. So just kind of matching up those in your process, matching up the paperwork so that everything looks good. Fourth financial driver are these things called capital expenses. These are big ticket purchases for buying kegs or tanks, maybe a new canning line. And these can involve debt. These can involve putting in cash, but they usually involve a lot of money. So one of the things we want to look at is, how do we measure the return on investment of these capital expenses, these big fixed asset purchases? How do we go about calculating that? So there's different ways to kind of control this spend, but the best way is to kind of do it before you actually spend the money. So very often we'll say, hey, we need a new X. In this case, we're looking at buying a new canning line. So if we just do a simple calculation and we say, all right, what is the basis for this? What is the return on investment? What might that look like? We can just take some simple numbers and say, all right, here's our scenario. We're using a mobile canning line, mobile canning company right now. They're coming in twice a month. They do 1,000 cases. It's $8 a case. So it's $8,000 each time, $16,000 a month. So if we do the math and we think, well, we can get a new canning line for $160,000, let's compare the proposed capital purchase price to what we're currently paying, say, for that mobile canning line. We're paying $16,000 a month. The new canning line is $160,000. Very simple math says we'll pay this back in 10 months. Now, there's other factors here, right? We're going to have to set the canning line up. We're going to have to figure out how to use it. We're going to have to pay people to actually run this thing. So the payback might be not quite as sweet as this is looking, but it gives you some starting points. And really what it's doing is it's forcing some analysis before the money is spent. So what are your expectations? Let's pull the numbers together, what we're actually spending and what this might look like if we do something differently. So that's just a very quick and simple return on investment. The other thing you can do to manage your capital expenses is simply create a capital expense budget. So this can look like this model right here. So a requested purchase, what do we want to buy? Which department is it for? Is this for the brewery, for the tap room? When do we expect to buy it and what's it going to cost? And who's requesting this? So for what I like to see for these bigger ticket items is we've got someone who's requesting it for a specific department, a specific purpose, and we can describe what it is that we're trying to achieve, whether it's a return on investment, financial, whether we're making improvements in, say, safety, whether we're making improvements in customer service, whatever the basis for it is. But the takeaway is to really kind of put some thought around it, document it, and have a structure so that we know what we're going to spend and when. And this simple grid can help you do that. So action items here: calculate the return on investments, create that capital budget so you know generally what you're going to spend. And I like to kind of go to each department manager, talk with folks in packaging, in production, in the tap room, admin staff, etc. And what do you need? What are some items that you need to do your job better? What are some items that can make us a better company? Some general questions. Where's an area where we could improve customer service or safety, in our brewery? And those can be kind of prompts for what we might need to add to the capital budget. Now, there's always the matter of paying for these things. So I advocate for setting up an equipment line of credit with your bank, which basically means going to your bank in advance and saying, these are the investments we want to make in our business in the coming year. You definitely want to do this in advance. And so the bank can kind of understand your situation. And if you meet the criteria, they can set up basically an open line of credit that's going to be specifically used for the purchase of equipment. So really what this does is it expedites the whole process. So you can have your plan, it's on paper, you're ready to go. You've already talked to the bank. They've set aside X amount so that you can purchase those new kegs or that new canning line. And then when the time comes, you can move quickly. The opposite, what happens is if we want to go buy that canning line for a couple $100,000, you identify the canning line, you go get a quote, you go to the bank or your equipment lender, and there's a process. It takes time. It could take 3, 4, 6, 8 weeks. And, meantime, you're waiting on that equipment. And particularly if you're buying something, say, at auction or on the secondary market where you can literally just buy it and it's delivered, that can be a really great way to kind of expedite everything. There's also lease versus buy options. So rather than buying the canning line, rather than buying the keg, there's always options for that. So doing the analysis, which makes more sense from a financial perspective, which makes more sense from an operational perspective. So those are just some action items to think about on that financial driver. The fifth one is loan payments. So this, again, is when we want to buy those assets, we're very often, depending on the size, we're going to have loans associated with it. So these loan payments, these are monthly payments, generally principal and interest. And one of the things the bank usually asks for is some sort of covenant. What they would say is like a financial promise. Like, I'm going to give you this money, and you're going to promise to deliver certain financial outcomes. And one that they look at a lot is this debt service coverage ratio. So basically, debt service, that's the payments that you're making on the loan. That's principal and interest. And the debt service coverage ratio is telling you how well your current cash flow is covering your debt payments. So when we talk about cash flow, banks are generally defining that as EBITDA, earnings before interest, taxes, depreciation, and amortization. And they may make a few other adjustments. So debt service, the payments we're making, debt service coverage, how well our cash flow is covering that debt service. So here's just a quick example of what that might look like and why this might be important if you've got the situation to measure these items. So if our debt service, we're measuring this generally over a period of time, generally over a year. So let's just say our debt service, our debt payments over a year, 100,000. Let's say we measure our EBITDA, that's our coverage, and we calculate it's 150,000. So we're going to divide the debt service into our debt service coverage. So the payments divided by the cash flow in, and we're going to get a coverage amount. So basically the cash flow, the 150, is covering 100,000 of debt service. And it's doing so by a factor of 1.5 to 1. So we cover 150,000 compared to 100 is a ratio of 1.5. So we have coverage of 1.5. So here the bank is going to tell us whether that's the right amount or not. So when you go to borrow that money, the bank's going to provide you with a term sheet. And on the term sheet, it's most likely going to say, we need to see a debt service coverage ratio of 1.5 or higher. The number is going to vary. It could be a little higher, it could be a little lower, but it's usually somewhere in that range. So you do the math, and we like to do this on a projected basis too, to say, all right, what do we expect our debt service to be? Well, we know that it's going to be 100. That's fixed. What do we think our coverage is going to be? What's our cash flow? We're not sure, but we have a financial plan. We can create those goals and those estimates, and then we can calculate the debt service coverage ratio and understand, if we're going to be in compliance. So one of the things to think about here, if you've got loans, you've likely got some sort of financial covenant. It may be debt service coverage, and adding that to your monthly financial reporting can be a useful way to keep your eye on the ball, because eventually you're going to have to send it to the bank, and if you're missing the number, the bank's not going to like that. They don't like that. Also, meeting with your lender on a regular basis. Most people don't want to do it because they just don't want to meet with their banker, and I understand that. But if we kind of shift it and say, well, the bank is really your advocate. They do want you to succeed. They want your money. They want your interest, of course, but nobody wins if you can't pay the loan. So meeting with them on a regular basis to review options to keep them up to date, they really like that. That's a great way to kind of strengthen that relationship. And it's also a good opportunity to talk about other ways the bank might be able to help you, i.e. that equipment line of credit that I had mentioned earlier. So those are some actions on loan payments. Loans are a big deal, particularly these days where, maybe pre-COVID, we had taken out a bunch of loans to expand, and now it's post-COVID and we're trying to get back to, and loans can be a challenge. So really watching them closely can be a big help. All right, so those are 5 financial drivers. If you focus, really the starting point is just pick one. What's most relevant for your business. For almost everyone, inventory is a big one, and then probably loan payments. So see if those are relevant for you. Think about those calculations and those scorecards. It's the classic: what gets measured and managed gets improved. So those are some ideas that you can try out to improve financial outcomes for your business. All right, so tactics to reduce costs specifically. Just going to give you a quick system that you can follow. Pretty simple and straightforward, as most good systems are, but to implement it, it can really make a difference. So 3 steps, and I'll run through these quickly. First is find out how and where money leaves your business. So really trying to understand the flow of money out of your business, and then inserting yourself in between your money and your money leaving. So putting yourself right into that money out process, really looking at, if I need to stop the flow of this cash, how might I do that? Where is money leaving? And then last is reviewing your past spending and making adjustments. So it's that old line, if you don't know your history, you're doomed to repeat it. So we want to, what have we been spending and where, and how's this been occurring, and what adjustments might we be able to make? So in that first step, finding out how and where money leaves your business, it might seem obvious. You may be like, yeah, I know where money leaves. But when you dig into it, maybe there's some surprises. So the typical ways that we're sending money out of our business would be through accounts payable. And that's typically a weekly process. Maybe we're getting our invoices in on Wednesday and Thursday. We cut the checks on Friday. It happens hopefully like clockwork. So okay, those checks are being generated based on these invoices, and they're going to go out every Friday, and then I can review those. I should be able to see a pre-check writing report. What are we going to write for checks? Okay, I don't want to pay this one or this one. So accounts payable is a big one. Manual checks is one that can kind of slip through sometimes. Oh, we had to write a check for such and such. Well, geez, so who's in charge of that? So as you're going through these, it's super important to know not only how or where the money's leaving, accounts payable management, but how, who has authority for, sending this money out. Payroll, usually folks are bi-weekly, so that's going out like clockwork. You pay, the money's drawn on a Thursday, gets direct deposited or checks paid on a Friday. We have a general understanding of what that number might be, but that's happening. The one that gets forgotten are these ACH or EFTs. These are transactions that are coming out of your bank directly. So we don't often, where some people may, look at the bank, online banking on a regular basis. You scroll through, what are the transactions here? Sometimes that's done weekly or even monthly. And when you're recording these transactions, the cash is already gone. So where and how does it leave? We want to look at our bank. We want to look at the past transactions. We want to look at any upcoming, what ACH or EFTs are out there. A lot of our suppliers and vendors like ACH because they don't have to send you, they just go in and take the money. Good for them. Maybe or maybe not good for you. So really just understanding what's coming out, how much money is that an expense I even still want to pay? So I think that's step one is, how and where money is leaving your business. Step two is how might you insert yourself into that process? So you understand where it's leaving. All right, got it. It's accounts payable, manual checks, ACH, EFT, and payroll. How do you, if you need to, put yourself in between the money and the money leaving? Number one is most simple is just signing every check. So if you have a bookkeeper or someone that's pulling together all your information, all your invoices and whatnot, getting it ready for signature, maybe you're signing them now anyway, but looking at these can be really illuminating experience sometimes. You may see some things like, why are we still paying this? Why is this so much? This could be an opportunity to reduce. So these details, devil's in the details. So that's one way to do it. Sign every check, review every invoice. And the big one here is to test your accounts payable process and your procedures. And I mentioned this earlier. And basically what this means is when you're writing a check and you're sending those dollars out, we want to make very sure that we're paying for the right things, that we actually received at the right amount. And the best way to do that is purchase order. So most of these brewery software systems really force you into good discipline, which is using a purchase order through the system, particularly for raw materials, packaging materials, anything that's going to go into the production and packaging of your beer. And that's the lion's share of your cost that's going out through accounts payable. Sure, you're going to have lease expenses and you'll have insurance and all those other things, but so the purchase order is going to define what are we buying and at what cost and at what quantities. So you get the purchase order, it's got to be approved. Then we're going to send that purchase order out, and then we receive the goods back, and we want to make sure that what we receive matches up to the purchase order. So we should get a packing list. Yep, I received 100 of these. I ordered 100 of these. Yep, the packing list may not tell you the price, but it'll tell you the quantity. Then the invoice comes in. And now you know the price. All right, quantity is 100. Price is, X amount. Everything's got to match up. And if it doesn't, we're not paying that invoice until we have a resolution on it. So that's a process that's fairly simple, but it's hard to, the timing is weird. Oh, where'd that packing slip go? Oh, it got stuck down in the warehouse somewhere. I never got that purchase order. Did you ever fill that out? So you got to follow. So you establish the process, write it out, teach your folks how it works. But you really got to follow up on it. So having the process in writing, you train people on it. But then what you can do, inserting yourself into this process, and make sure it's actually working. The third step is to review that past spending and make adjustments where necessary. So all of your spending is in your general ledger transactions. So basically, if you're using QuickBooks, you can run detailed general ledger transactions. You can scroll through and see, well, what did I spend here? We're sitting here in early April. Let me run last April. Well, what did we spend? And this is going to show you it's everything that you spent money on. And then you can identify, well, I don't need this anymore. That one I think we can cut back on. This is like, so many opportunities, and they're not easy, but at least all the information is there. So look at the same period last year. Look for those expenses that are upcoming. See if there's any changes that you can make. So those are just 3 steps that can make a real difference. We're going to kind of bring it home here with some financial planning. And again, this is really the roadmap. So if you have a financial plan, a budget, the next step is really to get it into your general ledger and accounting package. So for example, QuickBooks. So ideally, you'd establish your financial plan for the year. Maybe you do it in a spreadsheet, whatever you're most comfortable with, and you're like, all right, I'm good with these numbers. Now I got to get it into QuickBooks so I can track and measure against that each month. Because often we won't get the budget done, or we get it done and it's still in a spreadsheet, and we're not sure which is the most current version. And then I got to run QuickBooks, and then I compare it to my spreadsheet. It's a mess. So get it nailed down, get it into QuickBooks, run it each month. You can always go back and make changes. But these are the main components of that plan: your sales forecast, your margin projections, and your operating expense plan. So on the sales forecast side, it really depends how you're going to market: taproom, self-distro, through wholesaler, e-commerce, other methods. And we really want to have a forecast for each of those major paths to market. So you can start simple, and we talk about this all the time within your taproom. How do you forecast your sales? Multiply the customers that come in by the average amount that they spend, and you can extrapolate that over the current year. Do it by week, by month, and then you've got a decent forecast that you can track against. Margins, we really need to look at the full portfolio. Really depends on what you're selling. Again, if it's taproom only, it's a lot more straightforward. If you're distributing, you've got all sorts of different margin scenarios, and it's really important to dig in on that and understand, what am I making on kegs versus package? What am I making on this style versus that? Different package configurations have very different margins. So 12 packs, not so good. 4-pack, 16 ounce, pretty good. Everything in between can be, okay, depending on what your pricing and cost structures are. So really digging in on margins. Operating expense plan, we start with historically, what did we spend last year for lease, payroll, marketing, all the details. What are we looking at in the new year? What are the changes? And then building those up. Super important to have this. That's the income statement, sales, margins, and operating expenses. Don't forget the balance sheet. So a lot of the things that impact the balance sheet impact cash flow. And we talked about a number of these today, loan payments and capital expenses in particular. But looking at your balance sheet and using these ratios and benchmarks, super important part of the financial planning process. Because very often we'll say, if you're profitable, it's great, but it doesn't necessarily mean your cash flow is going to be good. For businesses that are growing, see this a lot, where sales are going like crazy, a profit looks good, and there's no money in the bank. What is going on? Well, we're sucking it all up, most likely in the things that we need to do for growth. We've got a lot of inventory. Holy cow. We've got a lot of accounts receivable. Boy, a capital, these fixed assets. We've had to buy a lot of things here. So those don't necessarily show up on your income statement and your profit. So we need to look at the balance sheet too. So that's a recommendation, is to project not only sales margins and operating expenses, but the major cash flow items on your balance sheet. And you can use a lot of those scorecards that I covered earlier for that purpose. So to recap, with the 5 financial drivers, pick 1 or 2 that works for you and test it out. Try the action items, use the scorecards, implement them, see if you can try these in your business, because the whole goal of this is to have you take action and make a difference. Information, great, but it's really about results. So I would love to hear if you try 1 or more of these. Did it work? Did you have questions? Did it not work? What did you get hung up on? So I'd love to hear any feedback people have if they try these things out. Tactics to reduce costs, the simple 3-step process. Take a look at that. And then obviously financial planning is critically important. Getting that roadmap down and diving in a little bit more on that. There's models here. So if you grab this QR code or go to Craft Brewery Financial Training, get the free course, watch some of the videos. You can pick and choose, download these models, and then you'll have all the goods there to build a financial plan for your business. So that is the presentation for today. I love numbers, and I hope you do too. I also love spreadsheets, and there's a lot of those on that free course. Would love to hear from you if you have questions, comments, any feedback, things you liked about this, things you didn't like about this. I can take it. I do have kind of thin skin. No, I'm just kidding. I want to know your feedback. So if there's information you're looking for that you didn't get here, or you've got information that you found helpful, please do let me know. It means a lot. Kary at Beer Business Finance. You can also go to craftbreweryfinancialtraining.com. There's a free newsletter there, lots of free articles and blog posts and videos and podcasts and all the goodies there. So thanks so much to Andrew Copeland and Craft Beer Professionals. Really appreciate you having me on. And if you guys try out these financial tips and tactics, I hope you find them profitable. Thank you.